Alright guys, what do we have today? You're watching Closing Trades live on Nifty now. What do we have today? Well, bit of a mid-air turbulence, more like a selling stampede. It is not a proper scare, but it's a day when markets have reacted to weak set of global cues. Now let me just define the intraday graph for you. Nifty is nearing 17,500. On any other ordinary day, Kunal, I would have said, okay, just a 300-point fall.
Correct.
But today the 300-point fall is taking you to the lower end of the range, which up until now has been this line in the sand. The Lakshman Rekha of 17,500 today is about to be broken. What does that mean?
No, I think it's, yes, of course, it's a significant, and I think there are two reasons for that. One, of course, is what happened in terms of the overnight US Qs, where we saw the US markets getting into a panic mode. So I think it's but obvious the reaction which our markets are following. And the second, the most important, is the expiry. And I think that's one of the more prominent reasons, because generally a day prior to the expiry or on the day of expiry, when you see big days for the markets, that's where major unwinding of positions happening. So I think today is the day where you will see volumes increasing up higher on the FNO side because of unwinding more rather than building of fresh shorts.
But Kunal, academically this level of 17,500 has been sacrosanct. Adani fiasco, FI selling, inflation scare, consumer slowdown, bad set of numbers, India downgrade, and yet we've not gone below that. Now if the market is threatening to go below that, some would say that ye to hona tha. This means that that important wall has been broken.
No, it is being tested again and again, but it is not being broken convincingly. So we went below 17,500 twice in the last 1 month broadly. I think on both the attempts, the markets took a very sharp U-turn. So maybe 50, 100 points here or there could be fine. But then I think the impact over here is that not too many large cap names are getting into a selling spree. So even if you do a small comparison, list of large cap names which were at the last time at 17,400 when the Nifty was at 17,400 compared to today when the Nifty is closing towards that 17,500 mark, the large cap names are substantially higher than those levels. That's a sign that the market breadth is not as weak as what probably the index is indicating.
Okay, now we've got some proprietary data of yours, Kunal. This is Kunal Botta's proprietary data. What Kunal has done is that you've looked at the market breadth, the advance to the decline ratio, and this is again in reflection of the poor market sentiment. So while you look at the Nifty from the lens of market from the lens of Nifty, it's not broken down. But the minute you turn your attention to what you're pointing out, Kunal, just walk us through the graphic and the importance of this.
So the importance is significant over here because the CMB indicator, that's the cumulative market breadth indicator which I have devised.
What is this index? First tell us.
So CMB indicator is basically an indicator of the health of the market. Okay. So if the market gets into panic zones or extremely oversold zone, the indicator goes into a level of which is below 10. Right now, as we are speaking, when the Bank Nifty was below 40,000 mark, the CMB indicator had hit levels of below 10. That has happened historically 4 or 5 times in the last 1 year.
Okay, so Kunal, I'll walk to the second graphic here, right? Let's go back to that CMB indicator here. What you're telling us right now is that we, of course, are not at the COVID panic.
Correct.
But we are not far away from the COVID panic.
Yes.
A COVID panic was when the world was under extraordinary threat. Everything had melted away.
Correct.
Stocks had got smoked 40-50%. Index is still standing at 17,500. So we are down 2-3% here or there for the year.
So
but
yeah,
the index is down.
We are nowhere close to panic. So there are two types of corrections which we see. One is a panic scenario where there is news flow, there is an event which is attached, where there is a lot of sentimental reaction from the markets. And the other is where the markets are confused. What is the reason for the sell-off? Like what we are seeing today. No one knows what is the exact reason of sell-off because there is no event or data to try and back this particular selling. That's the kind of a time where we go for -10 as a level for CMB indicator. And those are classical opportunities where markets bottom out. We get into a V-shaped recovery. Not just that, Nikunj, the data shows us that historically in a span of the next 1 month, and if you add to the data which we discussed in the morning, the range-bound data, both of them indicates that a major bottom generally gets formed in the next 1 month from these kind of levels.
Okay, Kunal, why we are at the wall is because Kunal feels that we are at a turning point, and our viewers would fondly recall that we had a similar chat when the dollar index was at 115.
Exactly.
And what a lovely coincidence, 2-3 days after that, the dollar index and the crude prices, they in a sense reversed. So you're sticking your neck out.
Yes.
And I'm standing with you.
Yes.
And we are bringing this part out that now the market are nearing a technical turn.
Correct.
The risk reward ratio is in favor of going long.
Correct.
Okay. What should one buy then?
So I think you start off with the index futures or index, I mean for someone who's buying index, you initially start off with large cap names. So I think because it always makes sense to bank on large caps first. and then look out for stocks on the high beta side. So I would start looking out for stocks which have been beaten down significantly. One of the examples which I gave recently is Bata India. I think that's a classical stock, 1400 levels.
So buy Bata, buy Nifty futures, buy TCS and buy Airlines.
Yeah,
That's a neat
buy
portfolio.
large captives.
What will challenge your conviction? See, there's nothing 100%.
Correct.
What we are judging is based on historical data. History may not repeat itself. There is no guarantee for that. Circumstances are changing.
Correct.
What will force you to revisit your opinion, if you can quickly tell us?
So I keep it very technical and very simple objective, Nikunj. It's a 2% sell-off from current level. So say assumingly we are 17,500 mark, a 2% which means 350 points. So if we break 17,150 mark, then this...
All bets are off.
Yeah.
Okay. So it's an interesting bit, Aisha, Anisha. Kunal is of the view that the risk-reward ratio now in this market, even though while we are looking at that 17,500 getting tested, that number, Kunal feels the risk-reward ratio is favorable. You should go long. The best way to do that is that you buy Nifty futures or you buy heavyweights like Reliance or TCS. He feels that till the time Nifty does not fall another 2%, he would like to stick to that rate. But if Nifty goes below 2%, then all bets are off.
Okay, let's see where we head from here, whether we head to that 200, 300 point lower range or not. But for now, it's not looking too pretty. Yes, we're off the lowest point of the trading session. At one point of time, we were just 30 points away from that 17,500 mark. We have now scaled back closer to 17,600. And the Bank Nifty also is showing signs of recovery, though it's still down a good 600 points. But at least a semblance of recovery is what we are seeing. From the frontline index, it's only 5 stocks that are managing to hold in the green. Separately, you have Adani Enterprises, which is taking a good amount of beating, 10% lower. Adani Ports has slipped 5%, and then Grasim, JSW Steel, even the heavyweights like Reliance, HDFC, etc. are putting a lot of pressure towards the downside, and these are the key pressure points for the markets as well. But let's welcome on board Naresh Mirani as well as Pankaj Murarka. Pankaj, I wanted to come to you and discuss what's happening with the market at the moment. There's no fresh negative trigger per se. The big triggers as such have already played out in terms of the earnings season, Fed rate, etc. What do you think is happening at the moment? Why is there no buying interest at all?
Well, I think markets are in a consolidation zone, and I think as we had spoken earlier, I believe that first half of this year, markets will remain so because we clearly have headwinds in terms of rising rates, but probably, hopefully, globally and in India also, rates should peak out sometime in the first half of this year. And also, given the fact that now it's been a year where index has been almost flattish, 1 year returns on a Nifty index are about low single digits. So I think there could be a bout of short-term nervousness or profit taking from retail and HNI clients. Institutional side, I haven't seen much. We haven't seen any significant sell flows in that sense over the last 3-4 weeks. So I still believe that the bias in the markets remains positive because the underlying growth in the economy and outlook for earnings remains fairly stable and healthy. Probably this is one of such phases where markets are sideways and probably will continue to remain so for the next few months.
Pankaj, if the market were to fall further from here, would you look to buy the decline?
Well, Aisha, definitely, first of all, the answer is emphatically yes. But for a long-term investor like us, we generally tend to stay very close to fully invested, so we don't hold much cash. But yes, we would certainly advise our clients that in case of any decline or dip in the market, one should buy into markets pretty aggressively because we still remain very constructive on outlook for economy and markets in that sense. So any meaningful correction in the market from our point of view is a good opportunity to buy into.
So that's exactly what I want to probe further then. What is it that you would recommend to buy?
Well, we haven't changed much. Our investment remains very much similar. So we like private sector banks. We like engineering and capital goods as a sector, which I've been talking about for almost a year now, because we think India's investment cycle is getting better every quarter, which was absolutely missing for last almost 10 years. And even in this earnings season, we have seen that most of the engineering and capital goods companies have shown very healthy growth in the order intakes. I mean, all of them have shown order intakes which are north of 20%, which is pretty good. And in the budget, the government has also laid emphasis on reviving growth through reviving the investment cycle. So I think engineering and capital goods sector looks pretty promising in that sense. And finally, the only change we've made is we've started adding more IT to our portfolios now. We've been grossly underweight IT all through last year. But we think now that valuations in IT sectors are far more reasonable, and the growth outlook is much stable or better in that sense, and that the fear of any sharp US recession leading to sharp downgrades in growth doesn't seem to be on the horizon. In that sense, IT looks good, and we've started adding IT to our portfolio.
Okay, so that's the take coming in as far as what Pankaj Murarka is buying at this point of time. But Naresh, wanted to get your view as well. What's the weakest link in the market at the moment, and what's the strongest link that one should look at perhaps buying or adding?
So the weakest link have been banks, because if you look at the bank Nifty, we are at 40,000. The budget day lows are at 39,500. It's corrected from 42,000, but that is not a space one needs to actually sell, or rather expect it to continue to be range bound. The space which is showing relative strength is, like I've been saying, public sector enterprises, which is where you get into Power Grid, NTPC, BEL, GAIL, ONGC. Then the second space is power, which is where you get into IEX, Tata Power. This is the one which looks interesting. And the third one is oil and gas, which is where IGL, MGL, Petronet, ONGC again coming back here. So these are the spaces where there could be clear outperformance in even in a sideways market, or even in a drifting lower market or a drifting upper market. I would be looking out for PSEs, power and oil and gas. That is where continue to like Power Grid, NTPC, MGL, IGL, ONGC, this whole basket.
Importance of Nifty. 17,500 line in the sand, Lakshman Rekha, strong support level. Is it getting tested? Well, it just got tested. We've just managed to see a dinky recovery above that. Rohit Srivastava joins us now. Rohit, what is the importance of 17,500? You go below that. Are we looking at serious downside in the near term?
So I think the short-term downtrend is something that's probably set in with today's move, because we are breaking the 20-day average, which was at around 17,824. It was trying to protect that for the last couple of days. So that much is done. What it does is it opens up the possibility that we retest 17,300. Now, to me, that's more of an important level, simply because the 20-month average comes in at 17,290. Now, all the declines that we've seen since June and July, each of these sell-offs have actually found support close to that average. So that average was much lower. Now it's come up, and we're going to be testing it. We tested it once on budget day as well, because that day we hit 17,300, and the level was close to just below 17. At 350, and we were close to 17,300. So around a 50-point difference was there. So we're coming close to that again. I think we're going to test it. If we break it, and the month end is really Tuesday, so if we do break it, then that would signal further medium-term weakness. If we manage to hold that, then we still have hope that this is just a pullback consolidation within what can be an ongoing upward trend that started from the June lows. So I think that's the critical decision-making point. But today's sell-off does raise a lot of concerns. I think even global markets, the S&P, for example, is sitting right on top of its trend line from the bottom that it actually made in, I think December or October of this year. If we take that trend line up, we are just very close, within 1%. So if it falls a little more than 1% or 2%, we would have broken that line. And that would then end up indicating that, there's further weakness coming in from global equities as well. So these are going to be the two critical things to watch.
So have you initiated short positions? Would you be looking at initiating further short positions if we decisively close below 17,500? And for those who are watching the show, should they cut off the long positions?
So there are two aspects to this. One is, of course, investors, and then there are traders. Now, traders, of course, moment we broke 17,719, the long trade is out for the time being. So there is a short trade. This short trade may be either a 2-3 day trade, which means only up to tomorrow, which is expiration. We end up retesting 17,300, and then we bounce back from there. So that is one possibility, which means there's only around a 200-300 point downside from here. Possibly not more than that is what would be the immediate view. Now, so we'll have to watch whether what really happens after expiration. Do we hold 17,300 or not on expiration? If that breaks, then it will be a trade that you can trail to much lower levels. How far lower? We would start looking for around 16,720. That will become the next level that we'll watch for once we break the 17,290 level.
You just wanted to understand a few pockets and how you are looking at them. The Adani group of stocks, they have fallen considerably now. They're actually, Adani Enterprises, for instance, is down another 11% today. What's your take on that? Reliance, that has been, in a very, very tight range. And then ITC, because that one is bucking the trend. Any thoughts on these three pockets?
So the Adani group is going to be tough because, whenever you've had such a news-based sell-off, you have to let things settle down. I don't think anybody would want to take a call on it at this point of time. So mostly we avoid. We've tried, I think, this month I did try to, sense whether the decline was complete, and we did get some kind of a bounce. But the selling seems to have resumed. So which is why it looks concerning. We don't know whether it will become a bigger cascading effect or not as of now, but it definitely spoils sentiment. So that's an avoid. Reliance is an interesting one because it has actually spent the last 2-3 years in a very peculiar trading range. It's actually not participated on the upside significantly with the market. And so it has this whole base close to around 28,000-2,700 where it can actually find support. It's done that recently as well. And so we were really hoping that, and we got that bounce, but today's sell-off, I think if it doesn't hold, for example, if we close down, say for the week, it would start looking like, was this bounce just a counter trend bounce, so the multiple supports, like I mentioned, around 2,300, I'm sorry, not 28, 2,300. Those multiple supports holding are essentially a good zone, for a longer term reversal for Reliance.
Great to have you on the show today. Thank you so much for taking the time out. Quick look at what the market is settling in at, 17,588. So we've managed to defend that 17,500 print for now on the futures, but still lower by a good 250 points, 17,579 on spot Nifty. Adani Enterprises now down nearly 11%, Adani Ports down 5.5%, Ambuja down 5.25%, and ABFRL as well for the last two trading sessions has really been getting whacked. Another 5% loss coming in for this stock today as well as we speak. Bad breath as well, all sectors in the red. Quick break, lots more to chat about on the other side.
Okay. Pankaj, we had a chat with the management of PB Fintech. I'm bringing this one up because you track the new age companies. The management is talking about 1,000 crore PAT in FY27. At a market cap of 20,000 crore, the stock is available. Even if they go on to do 1,000 crore PAT, and if the market cap doubles from here, will it be a reasonable bet? Because you're getting 1,000 crores of profit after 4 years, and at max, 1,000 crore profit could take the market cap up by 1x or 1.5x.
So, Nicole, see, the point is when you're talking about all these digital businesses, while the management has now set a milestone in terms of what they intend to achieve or deliver to shareholders 4 years out in terms of profits and cash flows, but I think that's not the the last point, in that sense that to my mind, probably that would be a point where business has reached some critical mark, but the potential cash flow, when you buy a business, you buy the business for a very long period of time for cash flows that the business can deliver across its life cycle. And I think the peak cash flows of that business can be significantly higher, because even at the scale at which they're operating and the fact that they're the largest digital insurance distributor in India, they're still 2% market share in India's overall insurance distribution, which effectively means they have a very long growth curve ahead of them. And markets have this tendency of pricing when growth is strong. Markets have this tendency of pricing a lot of that growth upfront. So eventually, if they deliver on that trajectory, let's say quarter after quarter, year after year, I'm sure the valuations out there will be far higher than where they are today. But more importantly, what I believe is that they have a significant growth runway even beyond what they've guided for. And that is what makes it a really exciting investment case, and which holds true for most or many of these digital companies, I would say.
Let's actually compare PB Fintech 1 year change, Zomato 1 year change, Paytm 1 year change, Nykaa 1 year change. Exactly a year ago, Nykaa was at the top of the pedestal. It was like commanding a market cap which was almost equivalent to the entire FMCG sector minus HUL put together, some kind of a crazy number. Nykaa, no, this is the wrong graphic. Bonus adjusted, please take it out. Let's adjust it, pardon me. We'll take Nykaa out. You got to look at Paytm, where there is no bonus. There is a buyback, which by the way is on. There is 1% decline in Paytm. So in last 1 year, Paytm is actually flat. This is today's graph, but last 1 year is what we want to look at. Last 1 year, it is down 25%. Now let's look at Policy Bazaar, which we just spoke about. And third, let's look at delivery. It's not been a year for delivery per se, but yeah, let's look at that stock. PB Fintech is still down 23% in last 1 year, and delivery is down 37% in last 1 year. So these stocks are nowhere close to what they were exactly a year ago, which means a lot of churn has happened in terms of the anchor investor. So Pankaj, that brings me to my next question, which is that the promoter holding in a Zomato or a Policy Bazaar or a delivery is low. The promoters of or the founders of Policy Bazaar, they don't own even 10%. Zomato also, the number is pretty much equivalent. So don't you think there is a lot of free float and there is a lot of supply which is going to be on in some of these stocks for at least 1 year?
Well, Nikunj, see, when you talk about promoter holding, we essentially have two issues at hand. One, in terms of does low promoter holding, does that influence our view on the business? And my answer to that is no, because we need to understand that these digital businesses are being created by entrepreneurs who are first generation entrepreneurs. These are not businesses which are brick and mortar businesses, which have, in India, traditionally we have businesses passing on from one generation to another in traditional business families. So effectively, when you're a first generation entrepreneur, obviously you don't have significant amount of capital, and the fact is that we have a robust ecosystem that they've raised capital at different points of time in their growth cycle, and as a result, the holding eventually is much lower than what we would see in traditional companies. And I don't think so that's a matter of concern. In fact, that's a pretty healthy thing that we have a vibrant ecosystem for entrepreneurs out there. As far as supply is concerned, yeah, that's it. I agree with what you're saying, that a lot of these private equity investors who are sitting in these companies have been invested now for a fairly long period of time, in some cases as long as 10 years. And they might want an exit because either the fund through which they've invested is coming to end of its life cycle, or they want to take money off the table. And it's still, in some cases, they're investors who are still in the money by a reasonable, handsome margin, because they invested in these businesses 5 years, 10 years back when the size of the business was very small. And which to my mind doesn't concern me again, because I think if the business delivers on the metrics, then there will be more than enough buyers for stock. And as a result, as these companies have made a rapid pivot towards profitability over the last 4 quarters, we've seen. You look at some of these companies when you're talking about, let's say, look at Paytm, or for that matter, even Policy Bazaar. Last year when they got IPO'd, look at the kind of losses they were making, and for them to make such rapid pivots on such a large business over a period of 4 quarters, where now they're almost close to or already done operational break-even, and now they'll start generating cash. I think that's a very massive pivot that has happened in these businesses over a period of over a very short period of time of 4 quarters in that sense. So I think the underlying fundamentals are strong, and if businesses deliver, then I think while it might create short-term overhang in terms of some sell flows from existing private equity investors, but I think markets have a mechanism to take care of that. So I don't feel too concerned as a long-term investor about these things.
Great to have you then on the show, Pankaj. We'll let you go on that note. In fact, we're on the subject of PB Fintech and the other new age tech companies. So let's hear it out from the co-founder and CEO, Yashish Dahiya. He spoke with Nikunj yesterday, and he clarifies that his stake has increased in the company and will rise further by about 1% since they went public.
My stake has increased and will hopefully increase further by about 1%. Since the point when we went public till now.
So why will your stake increase?
Because we had ESOPs, which when you get the ESOPs, you exercise them and your stake goes up. And when you exercise them, you also have to pay taxes.
Thank you.
So for that, you have to sell some shares. That is how it is for most people.
Has the public market forced you to rethink any of your strategies? The general mantra for a consumer tech or a fintech company was growth. And the more you grow, the more you are valued. That was the matrix which was used by PE investors.
Yeah.
But has the stock market or the public market compulsion forced you to rethink your growth strategy?
So one of my frustrations is that the public market will claim that it has forced us to rethink our strategy, while our strategy has not changed at all.
Or is it?
At all.
Okay.
It is exactly what we were going to do, is what we are doing. Nothing has changed. But my frustration is that we will not be given credit of that in the end, because the market will spin its own story. And so the market will, or the media will spin its own story. And the story that fits the narrative right now is that the public markets have forced the companies to go towards profits. We have done nothing new. Our business is exactly what it was. Nothing has changed.
But your expansion, maybe expenditure in terms of the new businesses which you are incubating, the employee hiring, all that has not changed because of public market compulsion.
Let me actually explain. It was after the focus on profitability in the public markets that we started a lot of our new initiatives.
Okay.
Which did not exist. So in 2021, we did not have anything called new initiatives. This year, I'll be making almost 250 crores of losses on new initiatives, which did not exist at the point of the public markets euphoria. So all I'm saying is, maybe we're different, maybe we're out of step with the market. Yes, our new initiative costs have been coming down, but that's exactly what was planned to happen, because they went up and they came down. It wasn't that we're doing anything different. And I think I would love for people to appreciate reality for what it is, rather than, spinning their own narratives and putting everybody in the same bucket.
SoftBank has sold half its stake.
Yes.
Tencent has about 9% stake.
About 5%.
About 5% stake.
Yes.
Okay, I stand corrected on that one. Are you getting a sense that more and more anchor investors are looking at reducing their stake?
I wouldn't have a clue.
So they did not approach you when they were selling in the public market?
I can tell you very candidly the conversation I had a call with all the anchor investors 1 day or 2 days before the lockup, and I told them I'm very, very grateful for all your guys' support. The company is strong, does not need your support at all. Do whatever you have to, and don't at any point believe that you owe the company something, and for that you have to hold on or sell or whatever else anybody tells you. I'm telling you this straight from my mouth. It was a 5 to 10 minute call, and that was it. And I don't think I have spoken to any one of them. Don't know. I can confirm I have never spoken to any one of them about whether they are buying or selling or what they are doing. That's their choice.